All right, in today's video, I'm going to take a look at the last bull move in gold and extrapolate if I think this pattern is going to play out during our present bull move, and I think it probably will. So I had somebody commented on my last tweet that when gold broke out above 1,000, it never retested that breakout, and it was just off to the races. And I swear, I guess these people don't even bother to look at a chart before they make these comments, but you can see that gold clearly did. It actually retested twice. We had a marginal breakout here, and then a retest, and then we had a big move, and then multiple months of very frustrating give back that came back down to fully retest the breakout right here. And then we started the sustained part of the bull move in earnest, and then we get the sort of semi-parabolic blow off top, and then that gives way to the multi-year bear market. So, if we step back and we look at this, and this is the 200-day moving average. And this is what I think we're going to see during the next 2 or 3 or 4 years of this bull move in gold. I suspect, I think there's a better than 50-50 chance, let me put it that way, that we're going to have to retest the breakout at about 2100 during this bull move as well. Now, I could be wrong, and gold could just go sideways and allow the 200-day moving average some time to catch up. That's always a possibility, and that's what I've been saying now for at least the last month, is that one of two things has to happen. We've either got to retest that breakout, or we're going to have to churn sideways for multiple weeks, or maybe even several months, and allow the stretch above the mean to work itself out. One way or another, we've either got to come back, test the breakout, or we got to go sideways. We're not just going to take off and go to the moon. That generally only happens during the final parabolic bubble phase, during this part of the move. But it takes a while to get to that kind of sentiment. You need a lot of weeks, well, you need a lot of months, maybe multiple years of this climbing the wall of worry. Price gets a little too stretched, you have to come back down and shrink some of that stretch, or you got to go sideways, or you got to do a combination of both, and gradually work your way higher as the 200-day moving average continues to trend higher. And then at the very end, you get this kind of a parabolic move where everybody is finally caught on that, hey, something is happening in the metal sector, and then you get a lot of unsophisticated retail mom and pop type investors jumping in at the end, and that's what pushes the parabolic move. So this notion that when gold broke out above 1,000, it never retested the breakout is just nonsense. Again, like I said, I guess these people don't even bother to look at a chart before they make these comments. So on to our present move. So you can see gold just got stretched a long way above this 200-day moving average, and we've seen what happens when you get this kind of a stretch. You either have to go sideways for a long period of time, or you've got to have a correction. So unless we're ready to just start the parabolic phase of this bull market, which I don't think we are, then that was my rationale for making this call that this part of the move, this initial breakout rally, was done. It was done on that big reversal on, I believe this was April 12th. We had a very large volume sell-off in the mining stocks, and the next Monday, I wanted to see if there was some follow-through on that. And the next Monday is when we took profits on this position. We rode this position up part of it we wrote up in leverage, and then we started to, and then we took our leverage down and we went to just unleveraged positions, and then we gradually sold those positions. Once we got that heavy, large volume reversal, key reversal right here, then we sold the next day, which was Monday the 15th. And now we're stuck. One of two things. We're either going to have to go sideways, and if that's the case, if this is sideways, then it's going to take several months for this moving average to catch up. It doesn't have to, completely catch up, but it has to shrink a lot of this gap. And so if you, let me widen this chart just a bit. All right, if I extend the 200-day moving average and just kind of keep it at that same angle of ascent, then in order for this price, if it's going to churn sideways, in order for this price to give this enough time for this moving average to catch up, then we're looking out to probably August before we're ready for the next leg up. So that's why I say I really don't want to see this unfold like that. I don't really want to see a sideways churn. I would prefer to see, I would prefer this to be a B wave bounce, and then we've got to have a C wave down, and the C wave comes back down to test. We've got a couple of potential pivots here. One is this pivot at about 2150, and then we got the breakout move that was right around 2090-ish. So somewhere in that zone between 2090 and 2150, that would shrink. It would shrink this huge gap between the moving average, and it would be much easier to pick the bottom if that were to unfold. And then and also the percentage move would just be bigger. If let's say, and my best guess is that the next leg up is probably going to take gold to 2,700 to 3,000. That would again stretch price quite far above the 200-day moving average. So assuming that we're in a 2, 3, 4 year bull move, similar to what happened once we broke out above that 2000 and I think 27 was the top. Once we broke out above that and started the sustained part of the move, then it took multiple years before we get to that parabolic blow off top phase. So I'm assuming the same thing's going to happen here, and it would just be much easier to pick the bottom, and the percentage move is going to be bigger if we could come back down and retest this breakout at between 2150 and let's just call it 2100. The percentage move from 2100 to 2700 or 3000 is bigger than the percentage move if this churns sideways and we start the sustained part of the next rally from, let's say, 2400. But we have to waste 3 more months as this churns sideways, giving this 200-day moving average some time to catch up to price. So for somebody that is trying to trade and not just holding, if you're just going to hold through this, and my advice remains the same, I think your buy and hold position should be in physical gold and silver. You won't be constantly looking or getting your calculator out to see exactly what your ounces of physical gold and silver is worth, and you're not going to panic when we get corrections. You won't panic if this does turn into a correction and comes back down to test 2090. You're not going to panic sell your physical gold and silver during that correction. Now, if you get caught in a leverage position and this goes back down to test 2100, you're going to do massive damage to your trading portfolio. So in my opinion, and again, this doesn't suit everybody, and these people that want to suggest that everybody has to follow their strategy of buy and hold is just absurd. Many people don't want to weather multi-week, multi-month, or even multi-year corrective periods, and in reality, miners have been in a corrective period since about 2010. I think that's when the top was. So all these buy and holders of mining stocks have been, have gone nowhere for 14 years. So that's what buy and hold gets you. Now, I don't think that's going to be the case here, because I think we've started, we've got the breakout phase. So I don't think you're going to have to hold for 14 years to get a sustained move at this point. But if this ends up being a choppy sideways move, you might have to hold till August before it's ready for the next trending move higher, unless we can. If this bounce can turn into a B wave bounce followed by a C wave down that retests the breakout, then you're not going to have to you're not going to have to wait nearly as long for the next trending move to start. That move would probably start somewhere, I'm going to guess somewhere in mid-June would be where we would get our bottom and then start the next trending move up, the move that's going to take us to 2,700 or maybe even as high as 3,000. So, I just don't listen to these people that think that everybody has to adhere to their strategy and that you have to buy and hold. You can have both strategies. You can buy and hold your physical gold and silver, and you can try and trade your metals or your leverage positions and try to avoid these drawdown periods during corrections, or these periods where it's just dead money, it's just not going anywhere. And again, I don't know which this is, but I do know that we're not ready for a sustained breakout yet. We have to have one or the other. I've been very clear on that ever since this reversal. This was the end of this first phase of the breakout. The breakout phase, that came to an end right here during this reversal. And now this could go either way, and I don't know which it's going to be. If it's going to be a sideways churn, then you're kidding yourself if you think that this is going to be over quickly and we're off to the races to 2,700 or 3,000 next week or the week after. It's just, the odds of that I would say, are less than 10%. The only way that's going to happen is if we're ready to start the bubble phase, and I think that's still 3 to 4 years away. So I just think you're on the wrong track if you think that this is just going to break out real soon and start heading to 2,700. If this is going to go sideways, you got probably 3 more months yet before you get the breakout and the move to 2,700. Now, if this turns into a B-wave bounce and then we come down and retest the breakout, then I think you only have maybe at most a month that you have to twiddle your thumbs and wait. And that would be the ideal situation for the trading part of your portfolio, because we could get in at that bottom when sentiment gets soured and people are finding, quote unquote, fundamental reasons for why metals are not going to go higher. That's where we could get in, and then we would have a quick move back up to these all-time highs. I would say it would, from a retest of 2,100 back to these all-time highs at 2,400 would probably occur in 6 weeks or less. And there would be a lot of money to be made in that move from the retest back up to the old highs. And then we would get a breakout and a run to 2,700 to 3,000 over the next month and a half to 2.5 months. And then you would have another corrective move that would, again, either go sideways or come back down to kind of hug this 200-day moving average as you climb the wall of worry, as we did back here. Let me see if I can just extend this chart. Here. So you get the breakout, and then you get a leg up, and the leg breaks out but doesn't make a huge move higher, and you get a corrective move. And then you get a breakout and a little bit bigger move above this pivot. And then you get, multiple months of choppy sideways, and then eventually it gives way to a corrected move back down to that 200-day moving average. And then you get another breakout here and a pretty decent move. And then this move, again, multiple months churning sideways, and then you get the parabolic move to the final bull market top. So this is what I'm looking for, is this kind of a move here that stretches above the mean, but then corrects back to it, and then stretching you to break out in a bit of a stretch, and then a correct, and then over and over again, 4 or 5 of these moves until we finally get our parabolic move to the top of the bull market. So when you listen to all the gold bulls, they're looking for an immediate breakout and run, and we're going to 3,000 immediately. This is just the kind of sentiment that happens when you get these powerful moves like this. It creates recency bias, and then traders are very eager to buy the first dip. But generally, the first dip is too early. You need either a second move down, or you just need a lot of weeks or maybe multiple months of trading sideways for this long-term mean to catch up, and then you're ready to move again. So the odds are about 90% I'm going to be right here, and so far I've been right. I said that this part of the phase, on April 12th, that was it. We were done with this part of the rally, and I've been right. And I suspect I'm going to continue to be right, and we're either going to have to go sideways till probably August before we can get a breakout and a sustained breakout higher. And by that I mean a breakout above this 2450 and a move to 2700. A marginal breakout, that's not what I'm talking about. We could, if we're going to turn sideways, you could come up here and get a marginal breakout. Maybe you would get to 2460 or 2470, but then it comes right back down, and you're stuck, in this sideways churn again. So this is what I'm talking about, and again, I've already been proven right so far. I think I'm going to be proven right going forward. We either have 2 or 3 more months of going sideways, or preferably, for anybody that can think logically, if you're if part of your position is in a trading where you are trying to avoid large drawdowns, which is what I suggest to do with part of your portfolio. Like I said, buy and hold is for physical. Trading is for minors and leveraged positions. For your trading positions, we would like to see this turn into a B-wave bounce and then a move back down. Much easier to pick the bottom, much sooner we're going to get that next trending move, much less frustrating, and overall we're just going to make a lot more money if we could come back down and retest this breakout. So I think the odds favor that. Almost all of these major breakouts do have some kind of a retest, so I'm going to put the odds at 60% that we do test this, 40% that we go sideways, and life would just be much easier for gold bulls if we come back down and test this. If we don't test this, you ignore these people that are calling for an immediate breakout and run to 2,700 or 3,000. The odds of that happening are very slim, and it would require basically that we've started the parabolic phase of this bull market, and I just think it's way too early for that.